Module 3P/E ratio benchmarks and comparisons. Using industry benchmarks and sector-specific P/E ratios can be helpful in evaluating a company's valuation in relation to its peers. Here's how you can use this approach: identify the industry and sector, determine the specific industry and sector to which the company belongs. This information can typically be found in company profiles, financial statements, or industry classification systems such as Global Industry Classification Standard, GICS. Research industry benchmarks. Look for industry benchmarks or indices that track the performance of companies within the same industry or sector. Examples include SP 500, NASDAQ Composite, or industry-specific indices. These benchmarks provide a reference point for evaluating a company's valuation relative to the broader industry. Obtain sector-specific P/E ratios, research and gather sector-specific P/E ratios. Financial websites, industry reports, and investment research platforms are good sources for this information. Sector-specific P/E ratios provide a narrower comparison base and offer insights into how the company is valued relative to its direct competitors. Compare company's P/E ratio. Calculate the company's P/E ratio using either the trailing or forward P/E ratio method, as discussed earlier. Compare this ratio with the sector-specific P/E ratios obtained in the previous step. If the company's P/E ratio is higher than the sector average, it could indicate that the company is trading at a premium compared to its peers. This may suggest higher growth expectations, better financial performance, or market optimism about the company. If the company's P/E ratio is lower than the sector average, it may suggest that the company is relatively undervalued compared to its peers. This could indicate potential investment opportunities or market pessimism about the company's prospects. Consider additional factors. While the sector-specific P/E ratio provides a useful benchmark, it's important to consider additional factors that impact a company's valuation. These factors include the company's financial health, growth prospects, competitive position, management quality, market conditions, and broader economic factors. Remember that the usefulness of sector-specific P/E ratios as benchmarks depends on the comparability of companies within the sector. It's important to consider factors such as company size, growth stage, geographic focus, business model, and other industry-specific dynamics. Using industry benchmarks and sector-specific P/E ratios provides a broader context for evaluating a company's valuation. It helps identify if the company is trading at a premium or a discount compared to its peers within the same industry or sector. However, it is important to conduct a thorough analysis, considering multiple valuation metrics and qualitative factors, to form a well-rounded assessment of a company's value. Relative valuation is an approach to valuing an asset, such as a stock, by comparing its valuation metrics to those of similar assets in the market. The P/E ratio is commonly used as a relative valuation tool to assess the attractiveness of a stock compared to its peers. Here's how relative valuation using the P/E ratio can be applied. Identify comparable companies. Select a group of companies that are similar to the one you want to value. These companies should operate in the same industry or sector and have similar business models, market dynamics, and growth prospects. These are the companies against which you will compare the P/E ratio. Calculate P/E ratios. Calculate the P/E ratio for each company in the group, including the company you want to value. Use either the trailing or forward P/E ratio, as discussed earlier, for consistency. Ensure the P/E ratios are calculated using a consistent earnings period for all companies. Analyze range and average. Examine the range of P/E ratios within the group of comparable companies. Calculate the average or median P/E ratio for the group. This provides a benchmark for assessing the valuation of the company you want to value. Compare the target company. Compare the P/E ratio of the target company with the range and average P/E ratios calculated in the previous step. If the target company's P/E ratio is higher than the average or falls towards the upper end of the range, it suggests that the company may be relatively overvalued compared to its peers. If the target company's P/E ratio is lower than the average or falls towards the lower end of the range, it indicates that the company may be relatively undervalued compared to its peers. Consider other factors. While the P/E ratio provides a valuable relative valuation measure, it should not be the sole determinant of a company's valuation. Consider other factors such as growth prospects, financial health, competitive advantages, industry trends, and qualitative factors in your analysis. Relative valuation using the P/E ratio helps investors understand how the market is valuing a company's earnings compared to similar companies. It provides insights into whether a stock is trading at a premium or a discount relative to its peers. However, it's important to use relative valuation as a starting point and to conduct further analysis, considering the specific circumstances and unique characteristics of the company being valued. When comparing a company's P/E ratio to its competitors and the broader market, there are several techniques you can use to gain insights into its relative valuation. Here are some common techniques. Industry comparisons. Compare the company's P/E ratio to the average or median P/E ratio of its industry peers. This can provide a relative valuation benchmark within the same industry. If the company's P/E ratio is significantly higher or lower than the industry average, it suggests a deviation from the norm, which could indicate overvaluation or undervaluation. Historical comparisons. Compare the company's current P/E ratio to its own historical P/E ratios over a certain time period. Assess whether the current ratio is higher or lower than its historical average. Significant deviations from historical levels can indicate potential overvaluation or undervaluation, depending on the direction of the deviation. Market index comparisons. Compare the company's P/E ratio to the P/E ratios of market indices, such as the S&P 500 or sector-specific indices. This provides a broader market perspective. If the company's P/E ratio is higher or lower than the index P/E ratio, it suggests relative overvaluation or undervaluation compared to the overall market. Peer group analysis. Identify a specific peer group of companies that are similar in terms of industry, size, growth prospects, and other relevant factors. Compare the company's P/E ratio to the average or median P/E ratio of this peer group. This allows for a more targeted comparison against companies with similar characteristics. Relative strength. Assess the company's P/E ratio relative to its competitors and the broader market over time. Track the changes in the company's P/E ratio compared to its peers and market indices. If the company's P/E ratio consistently outperforms or underperforms its peers or the market, it can indicate a sustained trend of overvaluation or undervaluation. It's important to note that these techniques provide relative valuation insights and should be used in conjunction with other financial metrics, qualitative analysis, and consideration of the company's specific circumstances. The interpretation of the comparisons should also consider factors such as growth prospects, financial health, competitive advantages, and industry dynamics.